Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, March 2nd, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story that's shaking up markets right now is the escalating conflict in the Middle East involving Iran. We're seeing oil prices absolutely surge, with US crude jumping over 7% on fears of supply disruptions through the Strait of Hormuz. This has triggered a classic risk-off move across markets, with stock index futures declining and gold rallying, a notable 2.8% as investors pile into safe haven assets. What's particularly interesting is how this is playing out across different sectors. European defence companies are soaring, airlines are getting hammered, and energy stocks are obviously catching a bid. The big question everyone's asking is what this means for inflation and central bank policy. We've got oil potentially heading toward $120 per barrel, according to JPMorgan's analysis, and that kind of move would put serious pressure on the Fed's ability to cut rates. On the corporate side, we're also digesting Berkshire Hathaway's latest earnings from Warren Buffett's final quarter as CEO, which showed operating earnings down nearly 30%. And the revelation that Buffett sold 75% of his Apple stake, while piling into a consumer-facing company for 6 consecutive quarters.
That's a significant development on multiple fronts. How are you reading the market's interpretation of these events, particularly the geopolitical risk premium we're seeing?
The market's reaction has been somewhat fragmented, which tells me investors are still trying to figure out if this is a short-term spike or something more sustained. Bitcoin actually showed some resilience, recovering to 68,000 after an initial dip, which suggests some traders view it as a potential hedge against traditional market turmoil. But the real concern is the inflation angle. If oil stays elevated, we're looking at potential 5% inflation risk in the US, which completely changes the Fed's calculus. Morgan Stanley is already mapping out how far oil needs to rise before it drags stocks into bear market territory. For traders right now, the playbook is pretty clear. You want to be long energy, long defense, potentially long precious metals, and very selective about growth stocks that can't handle higher input costs. The safe haven playbook is also defying traditional patterns, with bonds not getting the bid you'd normally expect, which suggests investors are worried about the inflation implications more than they're seeking safety. This selectivity is going to be absolutely critical in the coming weeks.
That selectivity is going to be key. Steve, let's get into the economic numbers. What's the picture looking like with today's data?
Thanks, Robert. Today we're getting the ISM Manufacturing PMI, which is a critical read on the health of the manufacturing sector. The forecast is 51.8, down from the previous reading of 52.6. Now, this is still above the 50 threshold that separates expansion from contraction, but the downward trajectory is worth noting. Last month, we actually got a pleasant surprise when the actual came in at 52.6, well above the forecast of 48.5. which suggested manufacturing was holding up better than expected. But if we see a decline today as forecasted, it could signal that the sector is losing some momentum. This matters because manufacturing activity has been bouncing around that 50 level for months now, and any sustained move below it would raise concerns about the broader economic outlook. Given what's happening with oil prices and the geopolitical situation, traders will be watching this closely to see if manufacturers are already feeling pressure from higher input costs. Looking ahead to the rest of the week, we've got some major releases coming. Wednesday brings the ADP employment report with a forecast of 45,000, up from the previous 22,000. Then Thursday, we get initial jobless claims with a forecast of 216,000 compared to the previous 212,000. But the real focus will be Friday, which is a packed day. We're getting non-farm payrolls with a forecast of 60,000, down from 130,000 previously, and that's a significant deceleration in job growth. We're also getting retail sales on Friday with a forecast of 0.2% growth. These employment numbers are particularly important right now because if the labor market is weakening while inflation pressures are building from higher oil prices, that puts the Fed in a very difficult position. The combination of slowing job growth and rising energy costs is exactly the kind of stagflation scenario that central banks struggle to address.
Those employment numbers are definitely going to be crucial. Lizzie, let's shift to crypto. What are you seeing in the digital asset space?
The crypto market is showing some interesting dynamics right now, Robert. Bitcoin is trading around the 68,000 level after recovering from the initial geopolitical shock. The sentiment is mixed, but leaning slightly bullish for the week ahead. We saw over $9 billion flee Bitcoin and Ethereum ETFs over the past 4 months, which is substantial, but institutional interest hasn't completely dried up. There's an interesting debate happening about Bitcoin's valuation relative to gold, with some analysts suggesting Bitcoin is undervalued on that basis and could see a rally. The NYDAG analysis points to potential tailwinds if AI developments prompt easier monetary policy, which is a fascinating angle. One thing to watch is that 46% of Bitcoin supply is now in loss, which is approaching the levels we saw during the 2022 bear market. For Ethereum, the outlook is actually more bullish. We're seeing continued institutional betting on ETH, despite the fact that it's down 60% from its 2025 high. Vitalik Buterin made some notable comments about AI potentially accelerating the Ethereum roadmap. And there's talk of Ethereum smart accounts launching within a year. The technical improvements and institutional interest are providing support even as prices remain under pressure. Solana is pretty much tracking the broader market, recovering alongside other major altcoins after the weekend sell-off. The key thing for crypto traders this week is watching how digital assets perform relative to traditional safe havens. If Bitcoin can hold these levels while gold rallies and stocks decline, that strengthens the narrative around it as an alternative store of value. But if we see another leg down in risk assets, crypto will likely get dragged lower as well. Position sizing is critical here because volatility is elevated across all markets.
Well, that wraps up today's Morning Bell. We've covered a lot of ground from geopolitical tensions to manufacturing data to crypto market dynamics. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we continue tracking these developing stories. I'm Robert, along with Lizzie and Steve, wishing you a profitable trading day.